Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online valuation services for mediation and litigation based in St. Louis, Missouri. Today, we're actually going to discuss a buyer's perspective and risk factors in business valuations with Al Danto. He has over 30 years of experience with startup companies, entrepreneurial companies, as well as expertise in the acquisition, valuation, and divestiture of business interests. He has served as a representative for a multitude of engagements. He has experience working with lenders, private equity groups, and individual purchasers or buyers. And he served on a variety of boards, including the alumni board of the Graduate School of Business at Rice University. He is also a full-time professor at Rice University, and he's a member of the NACVA, which I am also a member of. So welcome, Al. I think that one of the things that we're going through right now is what I've called the pandemic economy at this point. We're about a year in to the pandemic economy.
Hard to believe.
I estimate that we have another year, but nobody likes that suggestion. But I think that, part of it is what can we do? And, how can, if we're dealing with some of these risks, if we're dealing with the risks of the economy, if we're dealing with risks in our own industry, because we haven't talked about those specific risks.
Yeah.
What is it going to take to get a deal done in this current economy? And what are people looking for that maybe obviously is not falling on this list, but that people should really be focused on?
Yeah, I think we connected on the white paper that I wrote on getting deals done in the economy and how it's impacting valuations and certainly transactions in this space. And I think what's really happened is that these embedded risks that are in a business. So if you look at the return, and if you go back to the average business in America, and I'm talking about average is again, it's in the three to four times multiple range. So 33% return, 25% return. Why well, they're risky. And again, what I think happened, we had a really, really good tailwind going into COVID. I mean, and business owners would say, why would I want to sell my business for 4 times, 3 times, 4 times, whatever the valuation multiple is, pay my taxes on it when I can just keep continuing? Because next year isn't always going to be as good as this year or the previous year and the following years, right? You have these risks. It could be COVID. It could have been your sales reps leaving. It could be a new competitor stepping into town. It could be a new technology that steps in there. It could be a regulation. It could be something like that steps in there. So COVID and the pandemic was another risk. As long as you hold the keys to that business, you're responsible for all those risks. And COVID was a risk. A very interesting thing that happened during COVID, some companies thrived.
Yeah.
And they did really, 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 really well. I'm a part of a farm to market in Texas where we actually have ownership in a processing plant and some cattle, and that thrived. We had to shut down our Facebook page because we couldn't keep up. I mean, we got literally 3-4 months behind the thrive. But is it going to continue?
Right.
I don't know. Right. Other businesses really weren't as impacted by COVID as much, and some were severely impacted by COVID.
Mm-hmm.
So, the typical MBA question is, well, it depends. Well, yeah, it depends, but it depends on your circumstances that are in there. But you can't ignore this COVID risk. So how we're seeing deals getting done that we're advising on, and we had about 8 deals that we were working on going into COVID, and really we only had one that closed during COVID. The rest kind of got, we got delayed just a bit. And some we're one will close next week and one that's coming up. But the adjustment that was made was, okay, we're going to make the assumption that we're going to come back to pre-COVID numbers. But how we're going to adjust for that risk, we're either going to do it in valuation, where you're going to take a discount on it, right? Or we're going to give you X amount of cash up front, and we're going to hold back this, and we're going to give time to see if we want to come back to pre-COVID levels. And one thing they have to understand from a buyer's perspective, they want the business to do well. They want to give you a fair valuation. for the most part, and they wanted to grow. So we did this, a whole bunch. These were cash deals, and they got comfortable with it. They said, okay, that's fair enough. And it's hard to argue with that and say, okay, well, if we come back to pre-COVID levels, then you're going to get to pre-COVID. But if not, we're going to take it, or you can wait, right? And some chose to wait to see.
And that one rule that still pertains, which I think is even more relevant at this time, is that you have to show some consistent cash flow. And
Yes.
so if you had, because I have, the majority of my clients were very successful during COVID, so I think we see a lot of the headlines of a lot of companies that are struggling. And, obviously we're very concerned about those industries, hospitality, restaurant, and such. And then we have these other, kind of economies that were created based on the pandemic, based on COVID-19, and that will continue. But as we move forward into the new phase, it will be consistency. So you had good years. Maybe you had a banner year for 2020, right? Or maybe you didn't. Maybe you had a crappy year. Either way, if we look back from 5 years from now, we are going to remove it as non-recurring. So if you remove that out, you really do have to see, like, are we going to get back to 19 levels in 2021? Or is it maybe going to be 2022, right? Have we started the whole thing over, that we need to start to see 2 or 3 decent years, preferably, which way am I going to go? This way, right? And if you're not, I mean, that's just kind of general, because I think buyers could ding you if they see some volatility in your cash flow. Then they go the average. And then if 50 is average, if you could get $100 for your company and 50 is average, now are you okay with 50? And they'd be like, well, no. I want to be
exactly. Then you're gonna have to wait.
So you might have to wait. Or right now, I think that there's a lot of money that needs to be put somewhere. And so you have a lot of investors that are looking for alternate ways of investing their money, and there could be opportunities there. But they're not going to just ignore all of those risks that we just went through and say, oh, well, we don't care about your customer concentration. We don't care about your owner dependencies.
Right.
You're going to still be relevant, but it's also going to be like, how did you weather COVID? And
exactly.
In some cases, those economies may not exist after we've gone out of this pandemic. And so then what do you do in that capacity? So I think that there's a lot of things that somebody has to consider, even to make that move to exit.